Hi everyone, and thank you for tuning in. In this video, I will answer the question if AT&T stock is a buy. I will use my simplified 6-step framework for analysis, so let's jump right in. The first step in my framework considers the customer value. And for AT&T, they offer wireless internet and phone, plus they offer household broadband services, and they're relatively high prices, right, when you compare to others. And their revenue has grown from 127 billion to 169 billion as dependable phone and internet connections have become vital in our lives, right? We've become to rely on these services. And so if we need something to work, we're going to choose that service that we can count on to work, even if it means paying a little bit more per month. And so AT&T has attracted a lot of customers despite it's not cheap for its monthly wireless phone plans or its monthly broadband services. The next step in my framework considers unit economics, and for AT&T, they need to invest in the capacity, right? The cell towers to be able and the service, the technology at each but at each incremental customer, it expands profitability, right? They spend all of this money building the infrastructure, but then with each incremental customer, they're adding to their profits, right? Because they're not having to spend so much money to service each customer. The big cost comes in developing the network and building out that internet, that wireless technology network. And so gross profit margin has averaged 54% in the last decade. Those are excellent gross profit margins. And operating profit margin has averaged 15% in that same time. Compound earnings per share growth of 15% in the last decade. So excellent unit economics for AT&T. Total addressable market is the next step in my framework, and this is important because you want to see what is the opportunity for the business in front of it. Does it have already most of the customers that it will have, or does it have room to expand? And for AT&T, its total addressable market includes the 273 million people that have the 273 million smartphones in the US, so that they can offer those smartphones wireless internet and texting and phone calling plans. And then on the other side of their business, there is 129 million households in the US, and those are the potential customers for its broadband internet services. The next step in my framework considers competition, and for AT&T, its main competitors are Verizon and T-Mobile. This is for the wireless phone side of its business. In recent years, competition has been heating up as T-Mobile is disrupting the industry, right? Verizon and AT&T were content to have these relatively high prices and not battle each other on prices lower and lower. However, now AT&T is trying to come in and disrupt the industry. T-Mobile is offering lower prices than what AT&T and Verizon is offering, and so they're gaining market share and they're eating into AT&T and Verizon's profitability. On the other side of its business, the broadband market is similar to a utility business, with local markets acting like monopolies, right? If you have, in my region where I live, there's only one or two businesses that I can sign up to get internet from, and that's it. It's not like I have a group of companies that I can choose from. It's only one or two, and so that gives businesses pricing power to charge customers higher prices because they don't have to worry about so many competitors. Oftentimes, there's only, some people are fortunate to, have two or three. In some places, there's only one provider. And so you just got to choose, you just got to take what you can get. And so that's given them some pricing power in delivering internet to your home. The next step in my framework considers valuation, and AT&T, I was able to use the price to earnings ratio and the price to free cash flow because they've delivered consistent profits and free cash flow over the last decade. And looking at both metrics, price to free cash flow of 8.2 is on the lower end of the valuation going back a decade. And the same with price to earnings ratio. It's near the lower end of its valuation going back in the last decade. And more importantly, a price to earnings of 5.8 and price to free cash flow of 8.2 is inexpensive. It's cheap just looking at it in absolute terms. If you look at some technology companies, they're trading at price to earnings in the 100s, and some of them are not even profitable. You can't even use the price to earnings. So to buy a business with consistent profits like AT&T at a price to earnings of 5.8, the stock is cheap. The final step in my framework considers risks, and for AT&T, the primary risks I note here, one is that it's operating in a saturated market with little room for growth. Pretty much everybody who wants to have a smartphone with the wireless internet connection already has one. There's little room for growth other than new people entering into the market. As younger kids grow up, for instance, my kids are entering or approaching the age when I am going to want to get them a cell phone with internet access. And so that's where the growth is coming from, just new, as demographics increase, new customers come from there. But as far as reaching a market that doesn't have a smartphone yet, that doesn't exist. That market is saturated. And similar with the broadband side of the business, households pretty much already have high-speed internet unless they're in rural areas that is difficult for AT&T to even service those areas. And so that's a risk for AT&T. The market is saturated, little room for growth. And so when competition increases like it has been with T-Mobile, that risks eating into AT&T's market share. The second risk I note here is the business itself requires large capital investments to update technology. For instance, this most recently, it had to spend billions of dollars in this 5G expansion. And if it doesn't invest in this new technology and Verizon and T-Mobile do invest, then it risks missing out, right? If you're a customer and you can get 5G somewhere at almost the same price per month as AT&T will offer you, you're going to go with the 5G service, the faster internet connection. And so AT&T is going to need to constantly upgrade to the next level technology, and that's going to require large capital investments. All right, now that I've looked at each step in my framework, let's look at what grade I would give it in each one of these steps. For customer value, I would give them a B. They do provide reliable internet connections and reliable home broadband connections. They're not the cheapest option that exists, and so customers can get better value elsewhere, and for that reason I gave them a B in that metric. For unit economics, I gave them an A. They've delivered excellent gross profit margins, excellent operating margin, and excellent earnings growth, and that is closely related to its premium pricing. It's delivering good profits. The next step, total addressable market, I gave them an A minus here because the spending in the market is pretty big, right? Nearly 300 million cell phones and 100 million households that are spending $50 to $100 a month on internet, wireless internet, and home internet. And so that adds up, over the year, $500, $600, close to $1,000. But the reason they get a minus here is because the market is not growing. The market is already saturated. It's not going to expand at a fast rate over the next few years. Competition, I gave AT&T a B because of the actions that T-Mobile is taking, for the most part, offering lower prices, trying to take market share and disrupt the industry. Risks, I gave them a B. The anytime a business needs to have these large capital investments in new technology to sustain the business, it's a risky proposition because there's always a chance that it invests those billions into that new technology and customers do not end up buying that new technology, right? There's always a chance that customers will just all of a sudden not buy that service that they spent billions of dollars creating. And so that's a risk. And then finally, I looked at valuation, which I gave them an A plus, relatively inexpensive and absolutely inexpensive. Price to earning, price to free cash flow, both under 9. So they got an A plus in that metric. So now it's time to go on to answering the question if AT&T stock is a buy. But before we move on, let me implore you to subscribe to my channel so that you will get the updates on the stock, right? It might be a buy or a sell or a hold right now, but businesses are evolving, constantly evolving, and this recommendation might change a month from now, 3 months from now, 6 months from now. And so you're going to want to stay posted on the progress of the business. And so you know if you end up if something changes in the business, you're kept up to date on it, where other people are going to have that information. You're going to want that information too. You're not going to want to miss out. So please subscribe. All right. So now let's answer the question: is AT&T stock a buy? Yes, it is. AT&T stock is a buy. The absolutely and relatively cheap valuation combined with sustained and consistently excellent profits sways me strongly in recommending this stock as a buy. So there you have it. That's what I have for AT&T. Let me know what you think in the comments below. Thank you for watching, and I'll see you next time on the next installment of Is This Stock a Buy? I want to thank the Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for all investors of all skill sets and risk levels. So I'm proud to partner with the Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 3 times. Go to fool.com/Parkev to get your 10 stock picks now.